Okay, welcome to part 3. So, Nathan, take it away.
Could be that information on the trade and order book dynamics is used in such a way to push prices away from their true value temporarily when an institutional trader is detected in the market. On the other hand, institutions also use algorithms to implement their buying and selling, and also can actively try to hide in the order flow. High frequency traders likely use order book and trade dynamics to manage risk. A better managed market maker could benefit institutional investors by being a more stable market participant and being relatively less likely to suddenly reverse their normal activities and unload equity positions on the market. So, you could see clearly that there's strategies that need to be taken, when you're using automated market making. You've got passive trading, directional trading. There's so much really to consider. Malklavid 2011 hypothesizes on the growth of high-frequency trade and its influence on transition costs. He concludes similarly that high-frequency traders could improve the trading outcome of investors by providing quotes and linking markets. On the other hand, high-frequency traders might also negatively affect trading. If high-frequency traders trade aggressively on quickly processed public information, they effectively increase adverse selection on investor price quotes. This essentially eliminates the ability for investors to earn the bid-ask spread rather than pay it, which might make some trading strategies prohibitively expensive. For example, option replicating strategies. Also, speed might trigger a socially wasteful arms race among high-frequency traders. Finally, electronic markets might be particularly vulnerable to new manipulative or social destructive trading strategies. We've all seen that, haven't we? Other foresight papers examine market quality over time. Frederick and Payne, 2011, show the trends in market conditions though they are not able to infer causes for the trends. They find evidence consistent with CBT, computer-based trading, generating order flow that is more continuous with smaller trade sizes, more frequent traders. However, the impact of CBT, computer-based trading, is not necessarily the same for all types of stocks. The increase of CBT that has affected larger stocks may have diminished trading interest in the stocks of hundreds of smaller listed companies, with attendant negative impact on liquidity. While they find that CBT in liquid and large market capitalization stocks may have positive effects, they also observe that smaller stocks appear to have had a decrease in their liquidity. They suggest this may be a result of attention being taken away from these smaller stocks and instead being focused on the larger stocks. Linton 2011 studies show how UK markets have evolved over the last decade and finds fewer changes that are statistically significant. He finds no clear evidence for a change in price volatility, the frequency of large price changes, liquidity, market efficiency, or contribution to volatility from the intraday period. While volume has declined, it is hard to make a firm conclusion about the statistical significance of the recent decline in volume for the index. Luton and O'Hara 2011 survey the literature and conclude The evidence suggested that the computerized trading, whether in the guise of high-speed frequency trading, algorithms trading, has generally improved the market quality, liquidity as measured by bid-ask spread, and other metrics has improved over the last decade. During this period, transaction costs have also fallen for both retail and institutional traders. These liquidity and transaction cost effects have been particularly pronounced for large stocks. However, they do raise concerns, in particular the concern that while on average computerized trading may result in improved market quality, it can create episodic periods of poor market quality. Unlike traditional design specialist, high frequency traders typically operate with little capital, hold small inventory positions, and have no obligation to provide liquidity during periods of market stress. The speed of trade, as well as the interconnectedness of markets made possible by high frequency trading, can transmit disruptions almost instantaneously across markets. While Frederick and Payne, Luton O'Hara provide useful insights into time series properties of market quality, they do not directly examine institutional investors' trading costs or unravel the relationship between high frequency trading and trading costs. This paper examines whether there is a link between institutional investors' execution costs and high frequency trading. As there is an extent execution cost literature, we primarily focus on introducing the execution cost measure and describing the Anserno dataset. We use Anserno dataset to measure institutional investors trading across the UK securities. So really, the paper is going to determine whether there is a supreme cost. I'm not going to go through this because it's just name dropping and proving case by case by case that actually this hidden cost of of market makers being in the market is a negative cost. It just jumps to the conclusion that it's negligible. And really, looking at the data set is not, it's worth looking at. I'm not going to read through it, but look at the data set and, you'll get a good idea just from the charts and the stats. Is there an actual effect? Is there an actual added cost to the markets because of high frequency trading, or is the benefit of having liquidity vastly outweighed? So really, we got to look at the empirical methodology and the results. And we'll have to stop that there. Video's getting a bit long, so we'll see you over at part 4. Smash the Zioncoin up there, subscribe if you like, watch the whole series. Again, AMM, market making, the research, part 4. See you on the other side.